Hi, I'm Emma Wall, and joining me today is Tom McPhail to talk about what the general election means for your investments. Hi, Tom.
Hi, Emma.
So the major political parties have come out with some policies that will impact individual stocks, your investments and the stock market. Let's start with the one that seems to have got the most headlines, and that's the renationalisation of a load of utilities and train companies from Labour. What are the details on that?
Yeah, absolutely. And can I just add, it's not just Labour, the Greens as well. It's easy to forget about perhaps, but important as well. They have also said they want to nationalise rail and possibly water and energy companies as well. So there is support there for Labour, but you're right, Labour are the big beasts here. They want to renationalise all the rail franchises, they want to nationalise the Royal Mail, they want to renationalise the water franchises, the energy companies, and we heard only quite recently they're looking at broadband as well. This is big stuff. Now, they're saying they will pay fair market value for these businesses. There's a lot of anxiety about what that might mean in practice. And a real risk that if Labour get into power, we're fairly quickly going to see those stocks getting marked down in anticipation.
And we already have. I mean, it's been, although some of the detail is very new, talk about nationalisation for some of these stocks, in particular the train players and some of the infrastructure companies, is not new. I mean, Corbyn's mentioned this for a while, and I was speaking to an infrastructure investor a couple of months ago who said, although the values are depressed, actually it doesn't make good sense to buy in even at these levels because of the unknown. So it has already had a big impact on equity prices.
Yeah, I absolutely agree. And it's quite a binary risk for anyone who's invested in these stocks or thinking of investing in these stocks. Either everything's going to be fine, or potentially you could lose quite a lot of money. And it's also worth noting that investors in the stocks would not be paid in cash. They would be given government bonds in exchange for their stock. Now, exactly how valuable those government bonds will be is also perhaps open to question as well. So I think legitimately quite a lot of anxiety from investors around those financial stocks. Especially
for income investors, because if we look at the kind of dividends being kicked off equities at the moment versus the kind of yield you can get on a government bond, they're very different. So it could be, as you say, quite impactful if it goes ahead.
Absolutely. So one of the more transformational policy announcements we've had from Labour in the run-up to this general election.
What else is on the card?
So other stuff on the card, I think it's certainly worth picking out the Inclusive Ownership Fund concept. And interestingly, across the political spectrum, most parties would agree that employee share ownership is a good thing. What they differ on is the delivery mechanisms. So we've already had well-established save-as-you-earn schemes and share incentive plans. The Liberal Democrats are talking about, in their manifesto, giving employees a right to request shares in their employer's company. Whether that gets honoured or not is another matter. But Labour have said that they would introduce inclusive ownership funds which would require businesses to transfer progressively 1% a year over 10 years share capital from the business owners to an employee trust type structure. So the employees don't own the shares themselves, it's held in this inclusive ownership fund. The dividends from those shares would be paid to the employees up to a value of £500. In excess of that, the money goes to the Chancellor. So the government gets to keep the money. Now, this is quite a significant transfer of wealth. A recent FT article gave it a price tag of £300 billion worth of shares. That's not insignificant. And dividend distributions, depending on how they define it, of £5 to £10 billion a year. This is big stuff, and it would create a significant new stakeholder in the boardroom that business managers would have to take account of. It could also produce some weird anomalies. So, for example, a company like Fevertree, which has very high capitalisation but has very few employees, would not be caught by this policy because Labour are talking about it only applying to companies of 250 employees or more. If you put a threshold in like that, it could have impact on recruitment policy. It could have an impact on dividend distribution policies where the companies would start buying back shares again. So this is big stuff.
And it's not, as you alluded to there, without its complexities, because of course also the UK market is a very global market. If we look at some of the largest employers in the UK, they are often either global companies that happen to be listed here or global companies listed elsewhere. So what happens to those employees of companies that aren't truly British? Do they get captured by this? And so there is going to be, whatever happens, a lot of these things to iron out.
Absolutely, and we've seen some think tank papers on this already from an organisation called Commonwealth. They've put out some work on this, but there's not a lot of detail there, and we're going to need a lot of detail. I would not be surprised if Labour form the next government and if they introduce this policy. I wouldn't rule out legal challenges as well. It's big stuff.
And what else is going to affect the stocks?
I think the other one to look out for is the financial transaction tax, what's been called a Tobin tax, where a Labour government would introduce an additional, basically stamp duty on financial institutions trading in a spectrum of stocks and derivatives and so on. So they're talking about that raising £8.8 billion a year. This is not small beer, and this is part of Labour's overall fully costed manifesto. So there's big money for them. That would all be clearly a drag on all our investment portfolios, on our pension funds, on everything we hold. As those get turned over, there would be this tax drag on portfolios. Now, Labour argue that such a system rewards buy and hold investors, and investors that are just in it for a quick buck and turning stock over, well, they're going to be the ones that pay for it. But in the end, it will be our investments, our pension funds, our long-term future that has to pay for this strategy.
And of course, Labour has to raise the coffers somehow because they are spending in this manifesto. We were talking just before we went on air about the fact that this is a 100-page manifesto. So of course, in order to balance the books, they've got to be raising taxes and raising money in order to pay for the spending that they're promising.
Absolutely. Ideologically, this is a new kind of Labour Party. I think they take a view we've got potentially only one term to transform society. We're going to go all in on this. So given the chance, they will look to bring all of this in as quickly as they possibly can. It'll be a seismic change to society, and it will, as you say, there's a lot of spending pounds to be played for. So they will want to bring in a budget fairly early into the term of the new government.
Watch this space.
Absolutely.
Tom, thank you very much.
Thank you.